Welcome to the Warlords of Wall Street. Today in the market, most of the action we saw today is still bank related. United Bank Switzerland stepped up and paid about $3 billion through their regulators to pick up Credit Suisse. That was a bit of a surprise in our book. And we had mentioned last week that we were happy to take a little bite of that at the 790 range. It turns out that we were able to make a few percent on that, and we turned it loose today. We also had mentioned in our trading platform that we had picked up the Direction Regional Bank Fund, which is triple leverage the DPST over the Regional Bank Fund. KRE is its symbol. But we picked up the DPST last Friday at about $7.55, I think is the exact price we picked it up at. We were able to turn it loose this afternoon. It seemed to run up, jumped a little higher than we thought it would for any particular reason. And so we got out at 950 odd change in it, and that was a nice little profit. And we saw it retreat. Interestingly enough, it gave back quite a few nickels and dimes as it came back down, and closed under 8 again around the 770 range. I'm thinking and hoping that maybe we'll see it drop down another dime or so. I like to pick it up a little cheaper, but we continue to trade that successfully, and that's helped us keep a nice little roll going here in the early market. The big news is going to remain the banks. There is a lot of systemic questions about the health of the regional banks, and we touched on this last week that this is probably a situation that all of the banks are suffering from. And if you think about it, and I was explaining this to a client today, when the banks like SVB make a loan, and this particular customer of mine had just borrowed $100,000 on and put up a $500,000 piece of property for it. I told him the bank was only too happy to, no doubt, do that deal because they had so much collateral, a beautiful collateral ratio on the loan, and he got a fine interest rate on it. But as banks are wont to do, and the regulators insist, it's almost the barbell effect. If we've got a speculation over here, whether it's a business loan or what have you, on the other side of the books that tend to balance it out, the banks are going to invest in treasuries for the most part. And then when the regulators come in, they take a look at the speculation over here that they made the loan on, and the bank points to it's got good ratios, looks fine as far as they're concerned. The regulators tend to agree, but to ease their conscience, they look to the other side and say, and we invested in treasuries over here, perfectly balanced. We put $1 million here, we put $1 million there. Well, unfortunately, over the last 3 years, those millions that they were putting into the treasuries, the balance against the loans, were all at 1% or less is what they were yielding. Well, now that you're seeing the 3.5%, 4%, and Lordy, just a couple of weeks ago, they were flirting with 5%. Those bond portfolios that were created, purchased, the bonds that were held just as early as a year ago, just as early as 6 months ago, they have now suffered paper losses. Unfortunately, when the regulators come in and start looking at the books as they are scheduled to do at the first of every year, they'll come in and look, and what was a very healthy balance of a loan for $1 million and $1 million worth of treasuries. Now that $1 million worth of treasuries is worth 30 or 40% less because that dollar a year ago only bought a 1% return. Today, the dollar will buy you a 4% return. Well, who wants a 1% return? Who wants a bond that only pays 1 when you can go out and for $1 go buy something that pays you 4? So naturally, the bond that's only yielding 1% is going to trade for less. Well, I'm going to speculate, and I don't think I'm wrong, that all the banks have this problem. It's not just the little guys. It's not the regional banks that have this problem. Everybody has the problem. And this is the Frankenstein monster that the federal government created back in the collapse of '08 and '09. The too big to fail, they've now created a super elite club to where you're so big, yes, of course the government's going to stand behind you all the way because of the chaos it would create if a Chase or a Bank of America type ended up having an insolvency problem. But I can guarantee you that they've got the same kinds of problems on their books that SVB or any of the regional banks have. It's just that they're not being talked about. And the truth is, it doesn't matter. They're going to hold those portfolios, they're going to hold those bonds until they mature, and it will work itself out because the Fed is going to be in the process of probably not raising rates by more than 0.25%. And I hope that they do raise by 0.25%. I think that would be a signal to the market that they're not panicking about the bank situation, although they created it. They're the ones who made the 1% bonds worth a heck of a lot less by raising rates so fast that the same dollar today can get you a 4% yield. That's the Fed's problem. They created it. But these mega banks are a creation of their policy. And I don't think that any of them are immune from the portfolio problems, but you'll never hear anybody say it. And that's okay. They're going to go ahead, and this is all going to get swept under the carpet here pretty soon. This will be a hot news topic for another couple weeks. But on Wednesday, I believe we'll see Powell come out. He'll take a dovish approach. He'll give you the 0.25 point. I don't think he certainly isn't going to do a half. And there's about half of all the speculation out there suggests that he won't do any. I think if he doesn't do any raises to thwart the inflation that we're seeing sticking around right now, I think that is going to end up sending a signal that he is so concerned about the stability of the banks that he is not want to raise the rates at all. I think a 0.25 point would be a sign of strength and confidence in the banking market, and I think the administration is all about making sure that everybody's comfortable with that. Other than that, we're just going to wait to see what Powell does. I think we're going to see a little bit of volatility, as we always do. When there's a rate coming, a rate increase coming, the Fed will be meeting tomorrow, and then Powell will be taking the stand on Wednesday to tell us what they decided. And up until that, we've got nothing to do but just continue to watch the market, protect ourselves, take our profits where we can, and we're trying to keep as much powder dry as we can because there's some really nice deals to be had out there. And I think that the market's going to present us with opportunities. Everyone will see those opportunities here shortly. Other than that, we'll sign off as we always do. Be safe out there. Take your profits where you can. Keep your powder dry. And good luck in the markets.